This is a special production from WBRN Radio in Boston on the Boston Red Network. Under the Numbers Man banner, we normally produce a macroeconomics program called This Week in Economics. This particular program is Dr. Yellen's last news conference. She had that on the 13th of December. There were 2 days of meetings that the Fed had, and we'll get to the report in just a minute here. And we have also attached the entire news conference that she conducted, where she made a statement. We'll start off here with the Federal Reserve's actual statement that they put out on the 13th of December. Information received since the Fed Open Market Committee met in November indicates that the labor market has continued to strengthen and that economic activity has been rising at a solid rate. Averaging through hurricane fluctuations, job gains have been solid and the unemployment rate has declined. Further, household spending has been expanding at a modest rate. The key here is modest rate. Growth in business fixed investment has picked up in recent quarters. Over a 12-month basis, both overall inflation and inflation for items other than food and energy declined this year and are running below 2%. That is the Fed's magic number, 2%. Market-based measures of inflation compensation remain low. Survey-based measures of longer-term inflation expectation are little changed on balance. Consistent with the statutory mandate, that's the Humphrey-Hawkins Act, the committee seeks to foster maximum employment and price stability. Hurricane-related disruptions and rebuilding have affected the economic activity, employment, and inflation in recent months, but not materially altered the outlook for the national economy. Consequently, the committee continues to expect, with guidance adjustments in the stance of monetary policy, economic activity will expand at a modest pace and labor market conditions will remain strong. Inflation on a 12-month basis is expected to remain somewhat below 2% in the near term, but to stabilize around the committee's 2% objective over the medium term. Near-term risks to the economy and outlook appear roughly balanced, but the committee is monitoring inflation developments closely. In view of the realized and expected labor market conditions and inflation, the committee decided to raise the target funds rate 1.25% to 1.5%. In fact, they raised it 25 basis points. The stance of monetary policy remains accommodative, therefore supporting strong labor market conditions and sustain return to 2% inflation. One of the situations here is, in this particular economy, running at 2.5 and even 3% inflation is not particularly bad at all. And we'll get to that in a minute. In determining the timing and size of future adjustments to the target rate for the federal funds, the committee will assess, realize, and expect economic conditions relative to its objective of maximum employment and 2% inflation. The assessment will take into account a wide range of information, including measures of labor market, indications of inflation pressures, and inflation expectations, reading on financial and international developments. Now, this is something they have brought in that the Fed, back even when Dr. Bernanke took over and under Dr. Greenspan, did not take into consideration, and we'll get to some of that in a minute. The committee expects the economic conditions will evolve in a manner that will warrant a gradual increase in the funds rate. Voting for the monetary policy were Dr. Yellen, Dudley, Baynard, Harker, Kaplan, Jerome Powell, who would replace her, Randall Quarles. Voting against it were Charles Evans and Neil Kashkari, who prefer at this time to maintain the existing target range for the funds rate. given the dynamics of the economy and the tax cuts that are coming, the Fed did the proper thing, is to move the rate up to sort of cool things off. Let's go to a little extending things, and Dr. Yellen, in the question and answer, it's a brilliant synopsis on if you were taking a course in macroeconomics, where she starts talking about curves and straightening out of curves, etc. Let's go. This is from Money magazine. Tax cuts that could make it harder to fight the next recession by deepening the national debt. Now, that has been a big debate. At one time, the party in power now, the GOP, used to talk about prudent deficit cutting. Normally, this is from Money, devote vast sums of money to pay for tax cuts when the economy needs to be rescued from trouble. That's back to the old Keynesian pump priming. But in this case, it is not. The economy is not in a situation now where you need to prime the pump. This $1.5 trillion plan, and it's the best growth in 3 years. We should be paying down the debt. That is normally what you do. That's what Dr. Keynes talked about. You prime or borrow money in times of economic peril, recessions, or depressions, Great Depressions, or depressions as in 2008, and then you pay it back. So if you have a war, and of course there's all could be a war at any time, or a recession here. This is from J.P. Morgan Funds. David Kelly, he's the chief global strategist there. We need to use tax cuts, increase in government spending. We're in a position to do so now. That is why it's ill-advised. First of all, will it create additional jobs over and above what you have now? The Fed and Dr. Yellen, they decided to default to the Joint Committee on Taxation. The congressional scorekeeper estimates the Senate bill would only generate enough growth to create about $408 billion in net new reserves over a decade. That's 10 years. It's wrong to deficit finance a tax cut in a full employment economy. There's no doubt about that. National debt is roughly about $20 trillion. There's some that says 15 trillion, but when you get into trillions, you're up there. This means even including economic booms from the tax plan, the bill adds 1 trillion to the deficit. In other words, the tax cut may pay for less than 1/3 of the cost. That is a problem there. It leaves the government with fewer bullets during a downturn. That is from Jarrell Selsberg, managing director at Washington Research Group. The debt problem should keep people awake. The 8-year recession, we call depression. They call it Great Recession. We call it depression. Hasn't been robust, but it has been resilient. That's the recovery part of it. While a few economists anticipate downturns, another one would eventually come. Well, they do in a modern capitalist society. Our friends at Goldman Sachs warned in a report that large deficits and rising debt could reduce the ability to ease fiscal policy in response to the economic downturn. No doubt about it. The options of the Fed may be limited as well. The Fed has begun to raise interest rates and shrink its $4.4 trillion balance sheet. Both remain near crisis level. Chair Yellen told Congress last week that the American debt burden is very concerning and should keep people awake. She indicated problems will worsen in the as the country's population age group begins spending on Medicare, Medicaid, and Social Security will outpace tax revenue. And no doubt about it, that is one of the things the Trump people talk about working on, and it will have a great effect on the economy in the near term. Now, you're talking about this tax scheme that they have is a decade-long, 10-year tax scheme, but the problem is not so much the 10-year period. You'll get into, say, a 5-year period there, and then the last of the 10-year period. Now, no doubt you will have recessions, and depending on the severity of the recession, if it's a great recession, as they call it, or actually a depression, you could actually have that. The likelihood is less now because of things like Dodd-Frank, etc. But if you start taking off Dodd-Frank, then you run into some problems. And part of the problem you have now is you have a large shadow market. Now, we wouldn't include Bitcoin in as a shadow market, but Bitcoin is there, and we'll, as the phrase says, get to it in a minute. But it is out there, and as Dr. Yellen said, not to be confused with talk of a digital currency, or Venezuela has a cryptocurrency, is not necessarily a Bitcoin. Bitcoin is a highly fluctuated type of commodity. You'd call it a commodity. It'll be, in fact, some of it will be sold on the Chicago Board of Trade. But anytime you have that kind of speculation, it can go up and it can go down. Let me get back to this. Deficits of finance don't do little to reform the tax code. The code remains complex. There's no doubt about that. But the tax plan may not provide the kind of growth that justifies the cost. Goldman Sachs estimates the Senate tax legislation would boost growth about 0.3% in 2018 and 19, and set it in effect in 2020 and beyond looks minimal and could actually be slightly negative. It is one of the problems because what is happening in the economy as people age, you are taking people out of the economy. Until we fully get the robotic economy going, we are going to have difficulties of replacing workers. So what's happening now at the lower sphere in some locations, for instance, restaurants are only open certain nights because they can't find the workers there, and these are jobs that are basically around $10 an hour or less than $10 an hour. So it is very, very difficult. I was talking to a lady that had moved from Florida, and she was in healthcare, and there she was making, we'll say, about $12 an hour as a nurse's aide type. And when she had moved back, she's now at like about $21 an hour, $22 an hour. You can see the difference. And the rents in Fort Myers were a little cheaper than in Miami, Florida. But at the same time, you're talking about $1,500-$1,600 a month rent, and you see where that is going. And that's the type of economy that you create based upon taxing policies and various other things, particularly in right-to-work states like Florida, wages are low there, and at the same time, one sector of the economy, rents, because of population growth, have edged up. We don't want to get off on that too much. We are basically out of qualified workers and very close to it, and that will limit the growth. There's no doubt about that. That is from Kelly at, he's at Morgan. Stanley thinks that the tax overhaul will contribute a little bit to faster wage growth and hiring. But if you're running out of workers at the level in which they are running out, not only are they running out of workers, they're running out of competent workers, and that is a big, big, big problem. Some industries, as Chair Yellen said, have resulted to training people that were not a fit to try to partially train them. Again, to Goldman Sachs, said we did not estimate growth effects for these repatriated funds. That was one of the things they talked about. It suggests the money is likely to have a big impact on investments, massive share buybacks, and flat dividends. Wall Street seems to be betting that many CEOs will spend their tax savings on shareholders and not workers. Dow has soared 1,000 points over the past month, but that doesn't really do you any good. This is ambiguously positive to the stock market, unambiguously positive to the stock market. Kelly says the real question is whether the appropriate thing to do in the long-term interest of the economy. Markets are notoriously short-sighted, and this is a big problem in this type of economy. When you have a short-sighted market, one of the big things there, and a short-sighted administration also, you start running into big problems because you have a global economy. Things move much faster than, say, at the time of Ronald Reagan. Thus, what you have is, when you start talking about a 10-year cycle, you're only really talking about perhaps a 1.5 to a 2-year cycle, and that is where you are getting into some problems. Let me just shift over here a bit. We've already exalted the Fed. And this is from the Reuters service. We won't dwell much on it, but an early verdict on the tax overall. Policymakers, Fed policymakers judge it will boost the economy next year, but leave no lasting impact. Basically the same thing we came from money, with long-term potential growth stalling at about 1.8%. The White House has talked about 3 or 4%. This is not to say that you could have a good quarter next year, but perhaps Q2. We're not sure about Q1, but even Q1, where you have a 3% as you did in Q3 of this year, Q4. But can you sustain that? Very difficult to do because, first of all, you're running out of workers now. If you're talking about growth as far as the market, very speculative there, you will have some growth. But for instance, in construction, you had workers there, but they were repairing damage done by Harvey, etc. A little different situation. You will not have that up. And you also have a shortage of construction workers. And the real estate market is pretty much saturated at the higher levels. You can look to Toll Brothers and those types of buildings to see where they are. The Fed forecasts 3 additional rate in 18 and 19. That probably will occur there. Promise of monetary tightening. They will liquidate more and more of their balance sheet, no doubt about that. The Fed now envisions a burst of growth, ultra low unemployment, below 4%. Now, when you start dealing with 4%, and this is where the curve has straightened out there, you have low inflation, you have low unemployment, around 4%. It could even be a 3.11, 3.10. And you can also start to open up a deflationary period. They didn't talk about this, but it could very well happen. The short-term interest trader types are betting they'll raise it next year twice. The Fed now sees gross domestic product at 2.5% in 2018, up from their forecast at 2.1%. There, the pace of growth expected to cool in 19. And this is a part of the problem. You will have good years, and then you start to dry up because what is happening, your labor participation rate is not necessarily going to rise because as more baby boomers retire. And what is sort of happening here, you're having people not say at 65 and 62 to 65, but you also have a percentage of workers that are still working at age 70. So if you have people at age 70, DJ Trump himself, the president, he's 71, and I suppose you'd say he's still working, watching 8 hours of TV a day. So, but anyway, he's working. The impact would mainly work to raise the aggregate demand at households and companies that have more money to spend. Yellen said with some potential to raise investments. Yes, talk to people, their 401ks are up, say, 15% now. So in other words, that has happened before. The Fed says it expects the rate to fall. I think we just talked about that. I had not looked at this, to 3.9. Well, 3.11, 3.10, 3.9, and remain at the level in 2019, well below what is considered to be a full employment. In the old days, when Arthur Occam was around in LBJ, we used to talk about full employment being at about 2.2, 2.3. Very low, and you do have some states that are moving in that direction. But what that basically means is when you start having low unemployment, workers that desire work will come out. I was talking to another lady the other day, and this is where the economy affects real people that had 3 different jobs, literally. So if you have 3 different jobs, she's here, for 32 hours, over here for 20 hours, and then does some spot of work also. So when you have workers there, you're going to generate some types of cash in the economy. Now let's move on here. Back to Bitcom. This is one of these shadow market type organizations going through here. Fed's rate here, job gains in November. We talked about this before. 30,000 in healthcare, 46,000. Nice graphic here from Money, 46,000 in business, and 31,000 there. So they added in November 228K of workers. And we've already talked about the federal fund rate. We won't be too redundant here, but a good idea of where things are going. We covered tax cuts. We already did the Fed. This is Bitcom, and in the news comments you hear Chair Yellen talk about Bitcom is highly speculative, no doubt about it. A highly speculative asset is not a stable source of value, doesn't constitute legal tenure, no doubt about that. Bitcom started the year at basically below 1,000. And then he hit 8,000 for the first time in November, top 17,000 on some exchanges. And more I've seen, and we will append this, CoinDeck. One Bitcom was worth $16,200 on Wednesday, which is value based on data from 4 different exchanges. A little different situation there. So she thinks it's important to the Fed to understand what emerging risks are, no doubt. And she called the risk pose limited. It's limited at this point in time. You obviously, but it'll debut on the Chicago Board of Options Exchange on late Sunday. Futures will begin trading on the Merc on the 17th. That's just a few days. Means investors can place bets on whether it will rise or fall in the coming month, and it will debut on the NASDAQ next year. So in other words, it will become a much more a part of the economy, and very, very quickly. So we'll need to do some forecasting on that particular situation. Let me go to the markets here. We'll just go to the markets. I'll come back. I'll try to make this coherent as possible. The BBC Global 30 was at a negative 64.84. A lot of negative things going on here. The FTSE All Share, negative 10.68. In Amsterdam, they were negative 1.34. This is on a Thursday, today. The DAC, negative 68.04. In Paris, negative 15.73. In Brussels, negative 1.60. In Madrid, negative 36.20. In Zurich, today, 2.78. In Johannesburg, the All Share, this is from Friday. Well, let's get Moscow first. On Wednesday, the president of Vladimir Putin gave his live annual news conference today. We'll cover that on Boston Red on the World. That's our international channel later here. Hopefully today we'll get it in. Anyway, nonetheless, 28.81 there. In Johannesburg, they were in the negative at 294.82. In Bombay, 193.66 on today, Thursday. And in Karachi, negative 96.10 in Lahore. On a Friday, negative 45.11 in Colombo. On Thursday, 4.27. And in Tehran on Wednesday, 654.80. In Sydney, 6.70. In the Nikkei, negative 63.62 today. And Hang Seng in Hong Kong, negative 55.72. In Shanghai, negative 10.60. In New York on a Wednesday, 80.63 in the positive. The NASDAQ was at 13.48. The commodities exchange out in the Midwest city of Chicago was a negative 1.26. In San Pablo, 1,046.17 on Monday. And in Mexico on Friday, 648.42. And we go to the commodities, another very important part of a modern industrial economy. Brent crude futures on today down 0.22 cents at $62.48. The spot is at $58.59. It was down $1.35. West Texas Intermediate at $56.56, down 4 cents. T-Boone Pickens still jumping for joy. He remains $15 a barrel oil. The petrol prices here above $50. Even the shale oil characters can survive on that. They're about $6 or so up there. And Brent crude, Norway's doing well, and North Sea at $62.48. There's more money into the coffers of the Russian Federation, Venezuela, and the oil-producing companies that are producing oil. Anyway, ICE futures, cocoa unchanged. Gold on the Forex down $1.80 at $1,241.60. Dubai gold up $12.80 on Wednesday at $1,257.80. Silver down 7 cents at $15.70. To Euronext live futures. I don't know why we use those. We do. Cocoa up $161. Coffee up, holy moly, up $172 there. And even white sugar's up. All these commodity prices up, so Bitcoin follows 21.30. On Wednesday, the Bloomberg Index, 85.59. So everyone is up. Here we go. CoinDeck, where they are. Japanese shipping giant, IBM, to try blockchain in cross-border trade. Some of the headlines here: Walmart, JD Corn, etc. Retail giant Walmart and JD Corn are among several companies backing a new blockchain effort in China focused on food safety and traceability. So these, and they even talk about Yellen talking about highly speculative here. And let's see what else. We'll append this because they have moved to more stories here. Out with the old, blockchain requires a new regulatory approach. We'll just visit this briefly here, and we'll put it on Twitter feed. This is able to Kimberly is a member of the European Parliament. The Internet's once more appearing in transition. The cloud era that serves consumers and firms so well, so far, little by little, gives the pace to the age of decentralization, or the era of wherein the end user of computers will not only own and manage their own hardware in a decentralized way, but will also own and manage their own data in a decentralized way. DLT is a technology that will enable the transition. Neither an infant nor an adult. The technology is like a teenager that has already shown strong potential and growth and potential and raises great potential, but it will happen as in all teenagers. In order to materialize their potential, they need a disciplined framework there. In the case of technology, the role is played by enthusiasts who have adopted, and those who resist. Resistance to technology is not bad or negative. Historic experience has provided that the course of time resistance was undeniably essential in the advancement of technology and making it useful. In other words, in the case of DTLs, we see a real enthusiasm here. Moreover, it's not necessary to stress the disruption, impact of disintermediation, emerging of business models, decentralization, the value chain, and removal of transactional codes, and optimize the allocation of resources and risks. I'm not going into so much of this article here, but moving the role of the believer, the chain of regulations is challenging there. The benefits of blockchain. The first requirement is to create a level playing field for firms and consumers. No cookie cutter here. It gets us a very long article, but we'll finish it up. To sum it up, EU institutions have taken a positive approach. This is by necessity a multi-level approach. Different directorates of the European Commission have different courses. The European Parliament, I'll try to remove any fragmentation, provide a global view on the subject of the EU blockchains. Is a highly political subject. It is not economical. It is not about speculators making money. It's about reinvesting the concept of trust in a period where societies need trust more than ever to maintain and improve social coherence. By necessity, blockchain is an exercise of industrial transformation in which no citizen, no politician can stay indifferent. Blockchain requires our care and period there. So this is where they are, the benefits of blockchain. Let me just quickly go to this because financial institutions have financed disruptions of countless industries over the past 30 years. To stay ahead of change, banks have been proactive in setting up R&D laboratories there. Financial institutions were the first to dip their feet in, but academic, government, and consulting firms have studied the technology. I'll finish this up here. To discuss our guide, how does blockchain technology work? The identity component of blockchain technology is fulfilled through the use of the cryptographic key, combining a public and private key. You probably heard about this. Pretty good privacy is one out there. It's been out for a long time. A public key is how you identify in the crowd, like an email address. A private key is how you express consent to digital interaction. And the cryptography is an important force behind the blockchain revolution. Serves as a system of record. In the case of registry, data can be stored on a blockchain in a combination of three ways. Unencrypted data can be read by every blockchain participant in the blockchain is fully transparent. Encrypted data can be read by participants with a decrypted key. And hash mark can be presented alongside the function that creates it to show that the data was not tampered with. You'll see that in a lot of files that you download. It has the number there, and you can match that against the number you download, and you know it's not tampered with. The future of blockchain databases has a history in itself, because they are often called innumerable. In other words, they have a huge effect to change an entry in the database, because it requires changing all the data that comes afterwards. Every single node there, the server as a platform. Cryptocurrencies were the first platform developed using blockchain technology. Now people have moved from the idea of a platform to exchange cryptocurrencies to a platform of smart contracts. Vending machines, coined in the 90s. The smart legal contracts. Here some more things. You won't get much into that, but the private key of P2P networks. Blockchains are built in free technologies. The private key, cash versus plastic. The tree falls in the forest, and the program, the protocol, the tragedy of the common, the platform, the identity system of records, P2P networks, private keys, etc., is how we come about this. I'll put it on our feed. But this is effectively what happens. You have a private key, a public key, and you can basically go at it in the crypto world. Over time, they will get to be better in terms of people breaking in. Very hard to do. The algorithms will come up to be a much better, period. So these are some of the things that is happening. This coin desk, when we visited, last week I guess it was, is now turned into more of a journal type of situation, period. And as it evolves and being traded on all of these different exchanges in different countries, it will become much more a part of the shadow banking economy there, period. Let me just hit this one since we're kind of moving along here. How tax reform could impact crypto investors. The tax code is on the brink of its largest overhaul in 30 years. And so far, both versions scrap the like-kind exchange mechanism that many cryptocurrency holders use. In the past, the Senate version proposed a first-in, first-out accounting framework, which could complicate cryptocurrency token reporting. Yet proponents of reform, including DJ Trump and a majority of Republicans, argue that its goal to make paying Uncle Sam far less torturous of a process. Well, unfortunately, crypto holders, the Cryptocurrency Tax Fairness Act, in which somebody co-sponsored here, first in, first out is more of a wild card. The FOIC mechanism, Pacific securities, can be a big potential impact on specified security on cryptocurrencies. So this is very, very early. Are currently reconciliating their respective drafts. It's the House and the Senate. One provision only applies account by account, meaning that if the older Bitcoins are individually owned and stored in a separate account from the Bitcoins that they want to sell, or better yet, outside of an exchange account altogether, the rules do not apply. If you sell Bitcoins in 2008, you're going to be treated as selling the first that you bought. So take it off the exchange, hold it indirectly. When you want to sell one, you can deliver the one you want to sell. That's going to be a little bit difficult here. Going a step further, some traders want to consider selling off a significant chunk of their cryptocurrency before the end of the year to maximize capital gains. I guess they'd have to find out who you are. Anyway, this will do it for this particular report. Ran a little over, sorry about that. But this is Chair Yellen's final news conference. We did get into Bitcoin. Bitcoin is very, very big, our cryptocurrencies. And so to sum this up, you will have better technology, public-private keys. So in other words, the security will be there. And also at the same time, you'll have so many different sources. They'll be on these exchanges. People will be betting on that, where the Bitcoin is going. And then you'll have some older exchanges out there. And you'll also have exchanges that are more private. There'll be a lot of those out there. And where the value is, value goes out. And eventually, supposedly, with blockchain technology, hash marks, etc. I won't get very much into that. We'll talk about that on an open source report, which is on WBRN Radio and the Boston Red Network. We'll talk about blockchains, and we'll talk about hash marks, how it's done. We'll go into it a little bit more for the technical side, but here on numbers, man, we're basically talking about the economic impact, and more and more nations go into a digital type of currency. Venezuela went to it, but they're backing theirs up by the worth of the Venezuelan nation. A little bit different here, whereas your cryptocurrencies are only speculative. They could be $1,000 a day, $18,000 tomorrow. They could big swings. That will sort of go out, but again, you have such things as petrol. There's swings there, not big swings, but you can have $5 or $10 drop depending on the market. Now, again, we have to wait and see. On the 14th of December, good day. Stay tuned for Chair Yellen in her last news conference. And for those in business, remember to make the few days of 2017 productive. And the consumer, you have shown by the various days. I'm not sure where the so-called Santa shopping was done. Many people I've talked to have already finished that up.
Good afternoon. Today, the Federal Open Market Committee decided to raise the target range for the federal funds rate by 1/4 percentage point, bringing it to 1.25% to 1.5%. Our decision reflects our assessment that a gradual removal of monetary policy accommodation will sustain a strong labor market while fostering a return of inflation to 2%, consistent with the maximum employment and price stability objectives assigned to us by law. Before saying more about our decision, I'll review recent economic developments in the outlook. Following a slowdown in the first quarter, economic growth stepped up to a solid 3.25% pace in the second and third quarters of the year. Household spending has been expanding at a moderate rate, business investment has picked up, and favorable economic conditions abroad have supported exports. Overall, we continue to expect that the economy will expand at a moderate pace. While changes in tax policy will likely provide some lift to economic activity in coming years, the magnitude and timing of the macroeconomic effects of any tax package remain uncertain. Smoothing through hurricane-related fluctuations, job gains averaged 170,000 per month over the 3 months ending in November, well above estimates of the pace necessary to absorb new entrants to the labor force. The unemployment rate has declined further in recent months, and at 4.1% in November was modestly below the median of FOMC participants' estimates of its longer-run normal level. Broader measures of labor market utilization have also continued to strengthen. Participation in the labor force has changed little on net over the past 4 years. Given the underlying downward trend in participation, stemming largely from the aging of the U.S. population, a relatively steady participation rate is a further sign of improved conditions in the labor market. We expect that the job market will remain strong in the years ahead. You may have noticed that we altered the statement language about the labor market outlook. This change highlights that the committee expects the labor market to remain strong, with sustained job creation, ample opportunities for workers, and rising wages. We anticipate some further strengthening in labor market conditions in the months ahead. However, we expect the pace of job gains to moderate over time as we gradually reduce the degree of monetary policy accommodation. Allowing the labor market to overheat would raise the risk that monetary policy would need to tighten abruptly at a later stage, jeopardizing the economic expansion. Even with a firming of economic growth and a stronger labor market, inflation has continued to run below the FOMC's 2% longer run objective. The 12-month change in the price index for personal consumption expenditures was 1.6% in October, up a bit from the summer, but still below rates seen earlier in the year. Core inflation, which excludes the volatile food and energy categories, has followed a similar pattern and was 1.4% in October. We continue to believe that this year's surprising softness in inflation primarily reflects transitory developments that are largely unrelated to broader economic conditions. As a result, we still expect inflation will move up and stabilize around 2% over the next couple of years. Nonetheless, as I've noted previously, our understanding of the forces driving inflation is imperfect. As emphasized in our statement, we will carefully monitor actual and expected inflation developments relative to our symmetric inflation goal. And as I've noted before, we're prepared to adjust monetary policy as needed to achieve our inflation and employment objectives over the medium term. Let me turn to the economic projections that committee participants submitted for this meeting. As always, participants conditioned their projections on their own individual views of appropriate monetary policy, which in turn depend on each participant's assessment of the many factors that shape the outlook. The median projection for growth of inflation-adjusted gross domestic product, or real GDP, is 2.5% this year and next, and moderates to 2% by 2020. A bit above its estimated longer-run rate. The median projection for the unemployment rate stands at 4.1% in the fourth quarter of this year and runs close to 4% over the next 3 years, modestly below the median estimate of its longer-run normal rate. Finally, the median inflation projection is 1.7% this year, 1.9% next year, and 2% in 2019 and 2020. Compared with the projections made in September, real GDP growth is a little stronger, the unemployment rate is a bit lower, and inflation is essentially unchanged. Participants generally identified changes in tax policy as a factor supporting this modestly stronger outlook, although many noted that much uncertainty remains about the macroeconomic effects of the specific measures that ultimately may be implemented. Returning to monetary policy, for the past 2 years, the FOMC has been gradually increasing its target range for the federal funds rate as the economy has continued to make progress toward our goals of maximum employment and price stability. Our decision today continues this process. We still expect that the ongoing strength of the economy will warrant gradual increases in the federal funds rate. That expectation is based on our view that this rate remains somewhat below its neutral level. That is, the level that is neither expansionary nor contractionary and keeps the economy operating on an even keel. Because the neutral rate currently appears to be quite low by historical standards, the federal funds rate would not have to rise much further to get to a neutral policy stance. But because we also expect the neutral level of the federal funds rate to rise somewhat over time, additional gradual rate hikes are likely to be appropriate over the next few years to sustain a strong labor market and stabilize inflation around our 2% longer-run objective. Even so, the committee continues to anticipate that the longer-run neutral level of the federal funds rate is likely to remain below levels that prevailed in previous decades. This view is consistent with participants' projections of appropriate monetary policy. The median projection for the federal funds rate is 2.1% at the end of next year, 2.7% at the end of 2019, and 3.1% in 2020. Compared with the projections made in September, the median path for the federal funds rate is unchanged through 2019 and a touch higher in 2020. I should note that the economic outlook is highly uncertain, and participants will adjust their assessments of the appropriate path for the federal funds rate as their economic outlooks and views of the risks to the outlook change. Policy is not on a preset course. Additionally, the committee's balance sheet normalization program, initiated in October, is proceeding. As we've noted previously, changing the target range for the federal funds rate is our primary means of adjusting the stance of monetary policy, and we do not foresee a need to alter our balance sheet normalization program. Hence, our statement no longer mentions this program. Of course, we would be prepared to resume reinvestments if a material deterioration in the economic outlook would to warrant a sizable reduction in the federal funds rate. Finally, I'd like to note that although I have one more FOMC meeting to attend in the new year, this will be my last scheduled news conference. Over the next month and a half, I will do my utmost to ensure a smooth transition to my designated successor, Jay Powell. I am confident that he is as deeply committed as I have been to the Federal Reserve's vital public mission. Thank you for being such an attentive audience these past 4 years, and as always, I'll be happy to take your questions.
Marty, and then to Harriet.
Marty Krutzinger, Associated Press. Madam Chair, could you give us any insight into the discussion and how it dealt with the major tax changes that Congress is considering now? There have been thoughts that with these changes happening at a time when the economy is already with unemployment so low that the Fed may be forced to increase its pace on rate hikes. Did any of that discussion come up in your meeting?
So, yes, we did discuss tax policy, and let me say that most of my colleagues factored in the prospect of fiscal stimulus along the lines of what's being contemplated by Congress into their projections. Now, I should emphasize that some have been incorporating those expectations into their projections throughout the year. So changes to the projections that you see since September should not be viewed as an estimate of the impact of the tax package. And in particular, broader expectations of changes to fiscal policy have been reflected in financial market conditions, I think, over the past year. For example, we have seen a significant increase in the stock market, and at least some portion of that I would judge likely partly reflected expected tax changes. And that effect, along with other financial market effects, which affects, for example, projected consumer spending and would have affected wealth. That's been part of participants' forecasts now for some time. I think my colleagues and I are in line with the general expectation among most economists that the type of tax changes that are likely to be enacted would tend to provide some modest lift to GDP growth in the coming years, and you see that in part. That's one of the reasons, I think, for the uptick you see in estimated growth and decline in the unemployment rate. The views of participants, I believe, have been informed by a wide range of analysis, including that of the Joint Committee on Taxation and other outside evaluators. And my sense is that their estimates are essentially in the same ballpark, although they recognize, as I emphasize, that there is considerable uncertainty about the impacts, and that will have to be monitored over time. More specifically, they tend to see the package as boosting both consumer spending and capital spending to some extent. Now, to the extent that the changes do have positive impact on the growth of potential GDP and longer-run growth, let me just say that this is something that, should it occur, would be very welcome to participants, as long as it's consistent with the attainment of our employment and inflation objectives. I guess I would also urge you to remember that when you look at the projections, that there are many factors that affect those projections, and changes in tax policy, that's only one of a number of factors, including incoming data that has, to some extent, altered the outlook for growth in inflation. All of that factors into the projections you see. But I think bottom line, when you look at assessments of the funds rate path, participants continue to see gradual increases in the target rate for the federal funds rate as being appropriate to sustain a strong labor market and bring inflation back to 2%. And look, importantly, there is a lot of uncertainty about what the likely effects will be, and my colleagues and I will be committed and, as always, to evaluating incoming data and altering the outlook as appropriate.
Harriet Torrey with Dow Jones Newswires. You and others at the Fed have said that soft inflation should be transitory. Are you confident that that will still be the case, particularly regarding wage gains? They've been pretty moderate in recent months, yet the economy is growing and confidence is high. Is there something going on in the economy that's making it difficult for businesses to raise wages?
So it is true that incoming wage data suggests only modest upward pressure on wages. That leads me, that's one factor, along with the fact that inflation remains low, with feeling that even though we have a 4.1% unemployment rate, that the labor market is not overheated at this point. Remember, the modest pace of wage gains also probably reflects slow productivity growth. But when you ask me about the outlook for inflation, I've talked in detail about this in the past and recognized that there is uncertainty about what's holding inflation down. But my colleagues and I continue to believe that the factors that are responsible this year for holding inflation down are likely to prove transitory. That said, we all agree that our inflation objective is extremely important. We recognize that there's been a prolonged shortfall. This is a symmetric 2% inflation objective, and we continue to indicate that we'll be monitoring inflation developments closely. And so this is on the horizon and recognized to be one of the risks facing policy.
Thank you, Nick Temeros of the Wall Street Journal. Chair Yellen, I wanted to follow up on the question about tax changes. When you addressed it earlier today and when you spoke to Congress last month, you often described that you would welcome higher growth in the context of the employment and inflation mandate. And I guess I wonder how you judge the major provisions of the House and Senate tax plans, the corporate rate cut, immediate expensing of big-ticket purchases, new rates for pass-throughs, temporary rate cuts for individuals. do you see those on balance boosting the productive capacity of the U.S. economy as opposed to simply increasing aggregate demand? And related to that, how would you view the benefit of such tax changes now when the economy is nearing full employment versus at earlier periods when there was greater resource slack?
So I think my colleagues and I mainly see the likely tax package as boosting aggregate demand, but also having some potential to boost aggregate supply. So changes on the corporate tax side, the reduction in the corporate tax rate, expensing, will lower the cost of capital. And while there are a range of estimates and uncertainty about how much stimulus that will provide to investment, in general, I would see some stimulus to investment. In terms of aggregate supply effects, a stronger pace of investment could boost capital formation and thereby raise productivity growth and potential GDP or output to some extent. Exactly how large those effects might be remain uncertain, but that is a channel. And I suppose it's also possible, I'm uncertain how significant this would be, that lower marginal effective tax rates for those groups that will see them could boost labor supply. And again, there are a range of estimates in the literature. As I indicated, I think participants who've reviewed a number of pieces of analysis, including the Joint Committee on Taxation Estimates and the many outside analysts who have weighed in on this and been influenced by that kind of analysis. But there is a good deal of uncertainty about what the impacts would be, and to the extent that there are larger impacts than those analyses assume on aggregate supply or potential GDP, in the context of an economy that has had disturbingly low productivity growth, that would be welcome and could support faster GDP growth, at least for some period, without creating a need to tighten monetary policy to offset that. So there are potentially both demand and supply effects here. So importantly, you really don't, at the end of the day, see very much change in the federal funds rate path. Participants do recognize that the unemployment rate is lower than their estimates of its long-run sustainable rate. So I think we are in the vicinity of full employment.
Heather Long from the Washington Post. You've mentioned that the committee thinks there will be wage increases next year. I'm wondering if you could clarify if that is coming in part or mostly from the changes to the tax plan. Is that what the expectation is, would drive the wage increases? And I was also wondering, I've heard from so many female economists in academia and at the Fed about what an inspiration you've been to them and how melancholy they will be to see you go. I was wondering if you just had any final words to young females and minorities who may be looking to enter economics or banking profession and rise to your level.
I'm sorry, remind me the first part of your question.
Wages. Is the tax policy driving wage increase expectation?
Well, I think generally in a strong labor market where many firms are having difficulty finding qualified workers, we would expect just through normal demand and supply channels to see some upward pressure on wage growth over time. And as the labor market is tightened, we've seen some very gradual drift upward in wage gains. It remains at a low level, but would expect in the context of an ongoing strong labor market to see some upward pressure. And I believe that's the main thing that my colleagues are factoring in. On your question on advice to women and minorities, in the Federal Reserve, my colleagues and I are very focused on wanting to see and do what we can to foster greater participation of women and minorities in economics. We would love to, if we could, increase our hiring ourselves of women and minorities. And we see that both women and minorities are studying economics in disproportionately and disturbingly low numbers. Although the women in STEM fields generally are about even with men, represent about 50% in economics. Women majors constitute something like 30% of undergraduate majors, and there is disproportionate low enrollment of minorities. I will just say from my own experience, I think economics is a terrific field. I've thoroughly enjoyed my career in economics and think there are many different paths that people can follow that lead to satisfying careers, and that there are very interesting and important questions that economics addresses, and it is a great field, and would like to encourage greater involvement and think that people will find that satisfying. And just in terms of the kinds of research that's done in the field, I think also a greater diversity, more women and minorities, may change the focus to some extent of the questions that people choose to look at and the analysis that they bring in, range of thinking that bears on research, and all of that would be a healthy development.
Steve and then Donna.
Steve Leisman, CNBC. Every day it seems we look at the stock market, it goes up triple digits in the Dow Jones. To what extent are there concerns at the Federal Reserve about current market valuations, and do they now, or should they, do you think, if we keep going on this trajectory, should that animate monetary policy? Finally, maybe as a sign of what's been going on with valuations, this cryptocurrency called Bitcoin keeps going up every day. What is the policy of the central bank of the United States of the introduction, use, and incredible rise in popularity of Bitcoin?
Okay, so let me start, Steve, with the stock market generally. I mean, of course, the stock market has gone up a great deal this year, and we have, in recent months, characterized the general level of asset valuations as elevated. What that reflects is simply the assessment that looking at price-earnings ratios and comparable metrics for other assets other than equities, we see ratios that are at the high end of historical ranges, and so that's worth pointing out. But economists are not great at knowing what appropriate valuations are. We don't have a terrific record, and the fact that those valuations are high doesn't mean that they are necessarily overvalued. We are in I've mentioned this in my opening statement, and we've talked about this repeatedly, likely a low interest rate environment, lower than we've had in past decades. And if that turns out to be the case, that's a factor that supports higher valuations. We're enjoying solid economic growth with low inflation, and the risks in the global economy look more balanced than they have in many years. So I think what we need to and are trying to think through is if there were an adjustment in asset valuations with the stock market, what impact would that have on the economy, and would it provoke financial stability concerns? And I think when we look at other indicators of financial stability risks, there's nothing flashing red there, or possibly even orange. We have a much more resilient, stronger banking system, and we're not seeing some worrisome buildup in leverage or credit growth at excessive levels. So, this is something that the FOMC pays attention to. But if you ask me, is this a significant factor shaping monetary policy now? Well, it's on the list of risks. It's not a major factor. And then you asked about Bitcoin. And there I would simply say that Bitcoin at this time plays a very small role in the payment system. It is not a stable store of value, and it doesn't constitute legal tender. It is a highly speculative asset, and the Fed doesn't really play any regulatory role with respect to Bitcoin other than assuring that banking organizations that we do supervise are attentive that they're appropriately managing any interactions they have with participants in that market and appropriately monitoring anti-money laundering, Bank Secrecy Act, responsibilities that they have.
Has there been a directive, has there been a directive about Bitcoin to the banks and their dealings with Bitcoin from the Federal Reserve?
I don't believe there's been anything specific about that. Just generally, banks have Bank Secrecy Act, anti-money laundering responsibilities, and this applies to Bitcoin as it does in every other realm.
Donna, and then we'll go to Sam.
Hi, Chair Yellen. Donna Borek with CNN. To return back to the prospective tax bill questions, in your view at all, is the Republican tax bill an ill-timed fiscal stimulus? And are you concerned at all it will wind up squandering the tools both the Congress and the Fed have when it comes time to dealing with a recession?
So look, I will just say that it is up to the administration and Congress to decide on appropriate fiscal policy, and our job is to maintain our focus on employment and inflation. We continue to think, as you can see from the projections, that a gradual path of rate increases remains appropriate, even with almost all participants now factoring in their assessment of the impact of the tax policy. It is projected that the tax cut package will lead to additions to the national debt and boost, by the end of the horizon, the debt to GDP ratio. And I will say, and this is nothing new, it's something I've been saying for a long time, I am personally concerned about the U.S. debt situation. It's not that the debt to GDP ratio at the moment is extraordinarily or worrisomely high, but it's also not very low. And it's projected, as the population continues to age and the baby boomers retire, that ratio will continue to rise in an unsustainable fashion. So the addition to the debt, taking what is already a significant problem and making it worse, is of concern to me. And I think it does suggest that in some future downturn, which could occur just for whatever reason, the amount of fiscal space that would exist for fiscal policy to play an active role it will be limited, may well be limited.
Sam and then Victoria.
Sam Fleming from the Financial Times. A couple of longer-term questions. First of all, midway through the year, you talked about the issue of whether inflation targets might need to be raised. There's obviously been a lot more debate in the Fed system since then about this. It may not be an imminent issue, but do you expect it to be something the Fed should be discussing over the coming years, some sort of change to the inflation target? Second of all, the amount of stimulus tools that the Fed may have at its disposal when the next downturn strikes are fairly limited. One of the incoming governors, Marvin Goodfriend, has talked about the merits of negative interest rates. I just wondered whether you see that as a potential tool, at least in theory, for the Fed to consider should it run out of other options. Thanks.
So right now, the FOMC is not discussing or considering its inflation target. We do see inflation is likely moving up to target over the next couple of years, and I would say, you said our stimulus tools are limited. I would want to emphasize that if there were a negative shock to the economy, we do have some scope to cut the Fed funds rate, and there are other tools available, ones that we have used previously, forward guidance and asset purchases. So I think we're not out. I wouldn't say that we're out of ammunition, but certainly it's been recognized, and I've emphasized myself, that in the longer run we may be, and we'll have to see how this works out, but we may be in low interest rate environments where it could prove useful to have additional scope to conduct monetary policy. And in that context, I think additional research, the academic economists and others are thinking hard about what more could be done, and I think these are matters that are certainly worthy of further study.
So you do believe that negative interest rates, at least in theory, are possible in the U.S. at some point if it should be necessary, at least in theory?
So, I mean, on that I would say that's not something that we have studied inside the Fed to any considerable extent and haven't seriously thought about using ourselves during this last downturn and recovery. We have watched what's happened in other countries. I think that's worthwhile, and I would say it's an area that academics may have interest in the future and is worthy of some study, but it hasn't been part of the Fed's agenda.
Victoria, and then we'll come to Benya.
Hi, Chair Yellen. Victoria Guida with Politico. I just wanted to ask you quickly on the regulatory side. In your testimony to Congress recently, you spoke positively about the Senate Bank Regulatory Reform Bill, and I was wondering if there are, beyond that bill, if there are tweaks to Dodd-Frank that you think might still be beneficial. And then, somewhat related, Governor Powell recently said that there are currently no U.S. banks that are too big to fail. And I was wondering, do you agree with that assessment?
Well, I mean, I think I'm not familiar with every detail of the bill, but I think the bill does address a wide range of issues that, we've highlighted in the past as being ones where perhaps additional flexibility to tailor our supervisory requirements would be worthwhile. So I don't have additional things on the congressional list. Sorry, and what the other thing?
Too big to fail.
Oh, too big to fail.
Banks that are too big to fail right now?
So, we continue to work seriously on resolution and the resolution plans, the living wills, and the structure of systemic firms to ensure that it would be possible to resolve a firm under the bankruptcy code would be the top choice of methods, or alternatively under the orderly liquidation authority. And I think it's fair to say that over time we have learned more ourselves and more clearly detailed our expectations for the firms that file living wills, and the firms themselves have made considerable progress in changing what they do, whether it's adopting financial contracts that would facilitate a resolution rather than a disorderly unwinding of contracts, making sure that they're appropriately dealing with shared services so that key services would be able to continue, governance arrangements, legal entity structures. The firms have all made progress in adapting to our expectations of what would enable a successful resolution. So I think it's an ongoing process, and I believe we've made substantial progress.
Okay, Benya, and then we'll go to Justine.
Benya Applebaum, The New York Times. I'm struggling to reconcile the pieces of the economic outlook that you've described today. You've said that we are basically at full employment. You've said that you're expecting a tax package to deliver a significant stimulus and that it will be on the demand side. You expect growth to be faster, you expect unemployment to be lower, and yet somehow inflation is going to remain at 2% for the foreseeable future. Could you describe what has changed about your economic assessment so that everything has changed except inflation?
Well, the projections that we're showing you today, many factors went into that, fiscal policy being one of a number of different factors. And, you're looking at 16 participants who have made adjustments to their economic outlook for a whole variety of reasons, including, in some cases, rethinking some of the fundamentals that went into their original forecast. So there have been modifications in different directions by different participants. So I would caution you about the dangers of looking at the median and acting like that is one individual who has made a change to their forecast. That's a leap that isn't quite justified. But look, generally, you see modestly faster growth over the next couple of years, which is consistent, and I think for most participants reflects partly an impact from taxes stimulating consumer and investment spending. But it's not a gigantic increase in growth since relative to September. You do see a lower path for unemployment, but remember that inflation has also been running low on a persistent basis, and the committee does have a concern about inflation and wants to see it moving up. And on balance, you see only modest changes, slight revisions to the path for the Fed funds rate. You might think, well, shouldn't I see more? Well, okay, growth's a little stronger. The unemployment rate runs a little bit lower. That would perhaps push in the direction of slightly tighter monetary policy. But again, counterbalancing that is that inflation has run lower than we expect, and it could take a longer period of a very strong labor market in order to achieve the inflation objective.
Justine Underhill, Yahoo Finance. So William Dudley of the New York Fed recently said that the Fed is exploring the idea of potentially having its own cryptocurrency or digital currency. What use do you see a cryptocurrency could have for the Fed, and do you see the potential of a cryptocurrency that might be considered legal tender?
So I want to distinguish carefully between digital currency and cryptocurrency. There is a discussion going on among central bankers about the potential merits of adopting a central bank itself, adopting a digital currency. And there might even be a central banker or two around the globe that might go in that direction. But I really want to caution that this is not something the Federal Reserve is seriously considering at this stage. While we're looking at research on this topic, there are, I think, to my mind, limited benefits from introducing it, a limited need for it, and some substantial concerns. And so I would really doubt that the Federal Reserve would soon go in that direction. But it is something that central banks are looking at to see if there could be benefits from doing it.
Craig, and then Nancy, and then John.
Chair Yellen, before I ask this question, thanks for your stewardship of the economy, the benefits of which I've seen in some of the harder hit parts of my own family. So,
thank you.
Your tenure, we've seen 6 Federal Reserve presidents appointed. One was a woman and 5 were men. So I'd like to know how that comports with your commitment to gender diversity. And second, I wonder if you think this process of appointing Reserve Bank presidents needs to be more transparent and accountable. Recently, the Richmond Fed Board took 11 months and they came up with a candidate who was another Fed board member. And so I'm wondering what you would say to critics who say that looks like cronyism, and if you think, this could be simply a more open process. These are votes on national monetary policy, after all.
So I would agree with you that these are important appointments. Under the Federal Reserve Act, the non-banking directors of the reserve banks have responsibility for conducting a search, and the Board of Governors has to sign off on the candidates. We've made very clear, and we monitor ongoing searches very carefully to make sure that absolutely every effort is made to create a pool that is diverse, and that there be a national search, and that every attempt should be made to create a diverse pool. At the end of the day, we cannot guarantee that the outcomes of these searches will result in an increase in diversity. I mean, I've been very pleased to see that there's been some success in that regard, but we have signed off on the individuals who were appointed and have held the view that these are individuals who were qualified to serve in these positions. So I would hope to see greater diversity. It has been a challenge to achieve that.
Should the process be more open somehow?
Well, I think the process has become more open, and a number of the recent searches, there has been outreach, public outreach, information on websites, acceptance of potential names and nominees, and those have gotten careful consideration. There have been meetings in some cases with community groups to try to enlarge the pool and get suggestions, and I think that's appropriate, and I think it has moved in the direction you're suggesting.
Nancy Marshall-Genzer with Marketplace. I'm wondering if you have any advice for incoming Chair Powell.
Well, my colleague, I've had the pleasure of working with him now for many years, and he's somebody who understands the Federal Reserve very well and shares its values. And as I mentioned in my opening statement, he is committed to the mission of the Fed, to its independence, and to its acting in a nonpartisan, non-political way. He is somebody who has participated in the FOMC now for many years. To the best of my knowledge, he's been part of the consensus. I don't believe he's ever dissented. I think there is strong consensus in the committee for the gradual approach that we've been pursuing, and Governor Powell has been part of that consensus. So I feel he's very well positioned and very knowledgeable of all the ins and outs of everything that the Fed does in supervision, in the payment system. He's played an active role there, and in monetary policy, and I have confidence that he is very capable of steering the Federal Reserve in the years ahead.
Do you mean me or?
No, I meant John. But then Howard's next.
As long as everyone gets a turn. This is John Heltman with American Banker. Sort of a related question to what Nancy was asking. There have been some reservations among some Democratic senators recently during Governor Powell's confirmation hearing and during the markup of the reg relief bill about the approach towards regulation that the new leadership appears to be adopting. Do you have any similar reservations about the new leadership's ability to deregulate in an even-handed way that keeps an eye towards the stability of the financial system and the sort of the advances that have come from post-crisis regulation?
So I would say that all of my colleagues on the board have expressed a strong commitment to keep in place the core reforms that have produced a stronger financial system, and I'm considering their stronger capital, particularly for the most systemic institutions, higher quality capital, stronger liquidity requirements, a rigorous stress testing program, and resolution planning that will make it more possible to resolve a firm that encounters significant distress. So I have heard broad-based commitment to those things, and I think they are the core of the reforms we've put in place. I think all of us agree that it is appropriate to tailor regulatory requirements in all of those areas and others to the systemic footprint of firms. We've done a lot to do that, and I think there's more that could be done. And in some areas, it would require legislation in order to do that. But I believe all of my colleagues and I are in agreement on that. And we're also focused on community banks and want to find ways to relieve burden. So in those important ways, I do think that all of my colleagues are in the same place with respect to their priorities.
Are there any important differences between your colleagues and your vision on regulation?
So I have not seen anything emerge at this point that I would describe as a significant difference.
Okay, Howard and then Greg.
Hi, Howard Schneider with Reuters. So you mentioned in response to Steve's question that asset valuations you didn't think were on the sort of high priority risk list right now. So I'm wondering, what do you think is on that risk list? And more broadly, what have you left undone? You've gotten high marks for bringing the economy back towards its goals, but are there things that are going to nag you when you walk out of here in February and say, really, I wish I'd seen this to completion? I mean, we're not doing negative interest rates, we're not doing inflation framework. What's at the top of the to-do list that you are not getting to see to bring to ground here?
So you asked about the risk list. There are always risks that affect the outlook. We tend to focus in our own evaluation on economic risks, and we've characterized them as balanced, and I think they are balanced. I can always give you a list of potential troubles, international developments that could result in downside economic risk. But look, at the moment, the U.S. economy is performing well. The growth that we're seeing, it's not based on, for example, an unsustainable buildup of debt as we had in the run-up to the financial crisis. The global economy is doing well. We're in a synchronized expansion. This is the first time in many years that we've seen this. Inflation around the world is generally low. So I think the risks are balanced, and there's less to lose sleep about now than has been true for quite some time. So I feel good about the economic outlook. I feel, good that the labor market is in a very much stronger place than it was 8 years ago. We've created 17 million jobs. We've got a good, strong labor market and a very low unemployment rate. And I think that's been tremendously important to the well-being of American households and workers. And I feel very pleased when I hear anecdotes from firms that tell me they're having a hard time finding workers, and they talk about, given that they're taking on people with skills that don't quite match what they want, but they're training them and giving them the training that they need in order to be able to fill jobs. I think that's a development that is a natural one that occurs in a strong labor market that tends to build human capital and worker skills, and that's a strong positive. As I mentioned, I think the financial system is on much sounder footing, and that we've done a great deal to put in place greater capital, liquidity, and so forth that make it less crisis prone, and that has been an important objective. What's on my undone list, you ask? We have a 2% symmetric inflation objective, and for a number of years now, inflation has been running under 2%, and I consider it an important priority to make sure that inflation doesn't chronically undershoot our 2% objective, and I want to see it move up to 2%. So most of my colleagues and I do believe that it's being held down by transitory factors, but there's work undone there in the sense we need to see it move up in line with our objective.
We're going to Greg, and then we're going to Jen.
Thank you, Chair Yellen. What do you think will be the drivers of inflation over the next couple of years, and how long will the committee go with low unemployment, low inflation, before you rethink monetary policy, this gradual rate hikes? Thank you.
So, I think for a number of years, so we've had an undershoot of inflation for a number of years. We absolutely recognize that. I think until this year, undershoot was understandable. First, we had a good deal of slack in the labor market. Then we had plummeting oil prices. And beginning in mid-2014, there was a marked depreciation in the dollar. And those three factors held down inflation for a number of years. Now, in 2016, core inflation came very close to 2%. We seem to be on a path of inflation moving up. And this year, beginning in March, there seemed to be a sequence of negative surprises. Some reflect one-time factors that were easily identifiable, like a marked decline in quality-adjusted cell phone plans. There may be other factors that are not so easy to name, but we would judge, inflation doesn't always follow exactly. There are errors and many factors that affect it beyond the key influences of labor market slack, exchange rates and import prices, and oil prices. Those are three big ones, but there are other factors that affect inflation too. And our judgment at this point is that transitory factors that are unrelated to the broader macroeconomic outlook are holding inflation down. But I have tried to be straightforward in saying that this could end up being something that is more ingrained and turns out to be permanent. It's very important to watch it and, if necessary, rethink what's determining inflation. A possibility is that the longer-run sustainable rate of unemployment is low. It's been coming down. Estimates in the committee have come down. It's conceivable that they need to come down even more. It's not my judgment that inflation expectations have slipped, but that also remains a possibility that needs to be monitored. There could be a rethink of inflation. I think it's important to watch inflation outcomes carefully, and if we don't see inflation moving in the manner that the committee anticipates, to alter policy so that we do achieve our 2% objective. But at the moment, most of my colleagues and I believe we are on track to achieve it.
Hi, Chair Yellen. Jim Pusengarrow, Los Angeles Times. I'm wondering, you mentioned this is your last news conference. What are your plans when you step down from the Fed? Are you going to remain in Washington? Will you go back to Berkeley? And also, I'm curious if you have any disappointment that you're not going to be continuing in this job as some of your predecessors have done.
So on my plans, I don't have anything definite for you. I guess I have home in Berkeley and expect to maintain it, but I would say my spouse is on the faculty. He's a professor at Georgetown and would like to stay in his job, and we expect to maintain Washington as our base, but I don't have any definite plans. Let's see. And you asked me if I'm disappointed. So let me just say that I have served in senior positions in the Federal Reserve now for quite a long time. I became president in San Francisco in 2004, and I've participated in the FOMC since that time as president, as vice chair, and as chair. And it's been an immensely rewarding experience for me. I feel very positive about what we've been able to accomplish, and feel tremendous, loyalty to the institution. So I did make the judgment that this is the right time for me to leave, but I feel I have served in senior positions at the Fed for a long time, and it's really been an honor and a privilege for me to have had a chance to do so.
Adam, and then Mike with the last question.
Adam Shapiro with Fox Business. Glad to hear you're staying on the East Coast. I was just curious, I wanted to follow up to the Bitcoin questions, but because you've lived through what we all experienced in 2007, 2008, and should the Fed take a more active role in trying to identify who some of the counterparty and what the exposure is with Bitcoin as a potential threat to financial stability? Just the best minds at the Fed can sometimes miss these kinds of threats. Your predecessor, Mr. Bernanke, actually said in 2007 that the contagion from subprime would not affect the housing market or the economy. So are we underestimating the potential threat from Bitcoin as it runs up in value?
Well, I certainly agree that it's important for the Fed to attempt to understand emerging risks to financial stability, and to be looking not just in the banking system but outside it for developments that could pose financial risks. And we are doing that. And I would say one of the changes during my tenure is we decided in the aftermath of the crisis that we needed to devote considerable resources to financial stability, to monitor for emerging threats, and now we have at the board a full-blown division of financial stability that's involved in doing that. Now, when you ask about Bitcoin, I still see the financial stability risks from it as limited. Often risks threatening financial stability arise when there's exposure of the banking system to fluctuating asset valuations. And I really don't see any significant exposure of our core financial institutions to threats from Bitcoin if its value were to fluctuate. I don't see a threat to our core financial institutions. So undoubtedly there are individuals who could lose a lot of money if Bitcoin were to fall in price, but I really don't see that as creating a full-blown financial stability risk.
Okay, Mike McKee with the last question.
Michael McKee from Bloomberg Television and Radio. I suppose I should be asking you a valedictory question since it's the last question, but I don't think you can top what you've already said, so let me just do a couple of cleanup questions here. President Trump, while you were speaking, just said that he thinks his tax plan will produce 4% growth. Do you think that is possible? Second, do you think that there is any Fed blame or complicity in the flattening of the yield curve, and are you worried that there might be some sort of policy mistake built into that could slow the economy? And the last question, which is a bit of a valedictory, is one that everybody on Wall Street has wanted to ask you for 4 years. Since this is your last press conference, can you tell us which dot is yours?
Well, I can answer the last question first. The answer is no. I've never been willing to reveal which dot is mine, and I'm not going to change that now. So, my assessment, and I think most participants' assessments, as I said, of the impact of the tax policy on growth has been informed by work by the Joint Committee on Taxation and other analysts. And everyone recognizes that there's uncertainty about what the economic effects would be, and I wouldn't want to rule anything out. It is challenging, however, to achieve growth of the levels that you mentioned. Look, if the package were to stimulate growth of that magnitude, let me just say again, the Federal Reserve would welcome that. If it's a favorable supply side developments that would be compatible with the attainment of our employment and inflation objectives, that's something that would be very, very welcome, but it would be challenging to achieve numbers like that. Let's see, I think you also then asked me about the yield curve, and I mean, there is much discussion about yield curve inversions and whether or not a flattening yield curve could signal a recession. Is that the brunt of your question?
And whether the Fed has made it, if there's a policy mistake embedded in that.
So this is something that we discussed and have looked at. The yield curve has flattened some as we've raised short rates. The flattening yield curve mainly reflects higher short-term rates. The yield curve is not currently inverted, and I would say that the current slope is well within its historical range. Now, there is a strong correlation historically between yield curve inversions and recessions, but let me emphasize that correlation is not causation. And I think that there are good reasons to think that the relationship between the slope of the yield curve and the business cycle may have changed. And one reason for that is that long-term interest rates generally embody two factors. One is the expected average value of short rates over, say, 10 years. And the second piece of it is a so-called term premium that often reflects things like inflation risk. Typically, the term premium historically has been positive. So when the yield curve has inverted historically, it meant that short-term rates were well above average expected short rates over the longer run. So with a positive term premium, that's what it means. And typically that means that monetary policy is restrictive, sometimes quite restrictive. And some of those recessions were situations in which the Fed was consciously tightening monetary policy because inflation was high and trying to slow the economy. Well, right now, the term premium is estimated to be quite low, close to zero. And that means that structurally, and this can be true going forward, that the yield curve is likely to be flatter than it's been in the past. And so it could more easily invert if the Fed were to even move to a slightly restrictive policy stance. You could see an inversion with a zero term premium. So I think the fact the term premium is so low and the yield curve is generally flatter is an important factor to consider. Now, I think it's also important to realize that market participants are not expressing heightened concern about the decline of the term premium.